Stop trying to guess which asset performs best in 2026. It's the wrong question. In every systemic crisis, capital moves in a predictable sequence. Not because investors agree, but because the system forces it. First, gold freezes. Then, silver disappears. And finally, Bitcoin is the only thing left that can settle. This is not a comparison. This is a map of how money moves when trust breaks. The sequence is your only advantage. 2026 will not reward the asset with the highest price. It will reward the asset you can actually access. Gold fails by access. Silver fails by delivery. Bitcoin is what you use when both have failed. This isn't about belief. It's about understanding the sequence before you're forced into it. When trouble starts, the first stop for money is always gold. 2025 was a textbook example. Gold surged, while riskier assets like Bitcoin struggled. Gold did exactly what it's supposed to do: act as an anchor in a storm. This rally is not a fluke. It is driven by powerful fundamental forces. For years, central banks have been buying gold at a historic pace, de-risking away from fiat currencies and into the one asset with no counterparty risk. This institutional buying has been relentless. As we stand in early 2026, gold is testing the monumental $5,000 per ounce mark. Major banks are scrambling to update their forecasts. JP Morgan is targeting an average over $5,000 in the final quarter of 2026. And Goldman Sachs has raised their target to $5,400. Some analysts have even floated the possibility of $6,000 an ounce, driven by deep structural problems with global debt. With the US national debt now sitting at over $38.4 trillion, this isn't a small concern. Gold is the classic answer to a world drowning in debt. But the price of gold is not the same as access to gold. In a real crisis, the very system that prices your gold is the system that blocks you from using it. This is the great illusion of paper gold. Your ETF shares, your futures contracts, your unallocated accounts, they are all just promises for gold held inside a fragile financial system. What happens when everyone demands to cash in those promises at once? You get a freeze. A situation where the paper price detaches from the physical price. Custodians halt withdrawals. Vaults delay settlements. Exchanges declare force majeure. This has happened before. In 1933, the US government made private gold ownership illegal. In 1971, the US unilaterally severed the dollar's link to gold, freezing the ability of entire nations to redeem their dollars. The warning signs are already here. While paper gold flows are strong, the premiums on physical metal are rising. That tells you the demand for real gold you can hold is outstripping the supply available on paper. So when we talk about gold in 2026, we're not talking about a higher price. We're talking about it as a preservation tool. But its usefulness only lasts as long as you can access it. In the first phase of a systemic failure, capital flees to gold, pushing the price to incredible levels. That panic is what triggers the freeze. The vaults lock down. The paper contracts are settled in cash because there isn't enough physical metal to go around. Your golden fortress becomes a prison. The value is there on paper, but you can't touch it. This isn't a failure of gold. It's a failure of the centralized systems built around it. And it's the trigger for the next, more chaotic phase. When gold freezes, the panic shifts to the next logical asset, silver. But silver is a completely different animal. It is, first and foremost, a critical industrial commodity, and that is what makes it so dangerous. The story of silver in 2026 is all about scarcity. For the 6th year in a row, the world is facing a structural silver deficit. We are using more than we can mine and recycle. This isn't a future problem, it's happening right now. This demand comes from solar panels, electric vehicles, smartphones, and the advanced electronics powering the AI boom. Silver is indispensable. For these massive industrial users, the price of silver is an afterthought. A billion-dollar factory cannot shut down because it's missing a few $1,000s worth of silver. For them, delivery is everything. Silver disappears first because it is consumed, not stored. This creates an incredibly dangerous dynamic. As the financial system stumbles and gold locks up, monetary investors and industrial users make a run on the physical silver market at the same time. We saw a preview of this in 2025. Silver's price rallied hard but was brutally volatile. Now, in early 2026, dwindling inventories on major exchanges are a huge red flag. When the available stock vanishes, you no longer have a market, you have a bank run. This is where the price on the screen becomes irrelevant. It becomes a no-offer situation. It won't matter if the screen says silver is $90 or $150 an ounce. If no one is willing to sell you the physical metal, the market has failed. Analysts debating price targets are missing the point. The crisis isn't the price, it's the availability. The sequence is clear. First, gold freezes. The big money realizes its paper claims are at risk. That shockwave sends everyone scrambling into phase 2, the panic into silver. But because silver's physical market is so much smaller and already stretched thin by industry, it cannot handle the flood. The inventories are wiped out. The choke point is reached. This vanishing of silver is the loudest alarm bell you'll ever hear. It is the market screaming that the plumbing of the global supply chain is breaking. It is the final signal that trust in paper promises is gone, right before the last phase of capital flight begins. We are about to enter the final phase of this sequence, Bitcoin's role as the last resort. If you want to get these signals before the market does, subscribe to our newsletter. It's where we share insights that are too timely for video. The link is in the description. After gold has frozen and the silver market has evaporated, where does capital go? When the systems of trust and delivery have failed, the market has one problem left. How do you settle a transaction in a world with no trust? This is where Bitcoin enters. Not as digital gold, but as a neutral, unstoppable settlement layer. Bitcoin's performance leading up to this moment has been the opposite of gold's. While gold soared in 2025, Bitcoin lagged, entering 2026 trading around the $90,000 mark. ETF outflows have been significant, and market sentiment has been fearful. Many have written it off, pointing to its volatility as proof that it failed as a safe haven. This misunderstands Bitcoin's purpose. Bitcoin was not designed to be a stable store of value like gold. It was designed to be a peer-to-peer electronic cash system that nobody can stop. Its core innovation is final settlement without a middleman. In the first two phases of this crisis, the failure points were the middlemen. The gold custodian who couldn't deliver, the exchange that ran out of physical silver. The entire system of IOUs was the weak link. Bitcoin has no such weakness. There is no vault to raid. There is no CEO to subpoena. There are no delivery hours. When you hold your own Bitcoin, you hold the cryptographic keys. No one can stop you from moving your wealth. It is the ultimate escape from counterparty risk. This is why, in the final stage of a systemic failure, Bitcoin becomes the asset of last resort. When you can't get your gold and you can't find any silver, the need to move value doesn't go away. A business must pay a supplier across a closed border. A family must flee a country with their life savings when the banks are shut. In those moments, Bitcoin's volatility is a secondary concern. The primary concern is access and mobility. Can I move my value from point A to point B right now with 100% certainty? With Bitcoin, the answer is yes. Price predictions for Bitcoin are all over the map, with some, like Standard Chartered, revising targets down to $150,000. But focusing on price misses its function in this sequence. In this scenario, Bitcoin's price surges because it becomes the only working rail for settlement. Its value isn't the price, it's the utility. It becomes the world's default settlement layer because it's the only one left that works. Think of it this way. Gold is for hiding wealth. Silver is the alarm that the system is breaking. Bitcoin is for moving your wealth, when the system is broken. This isn't a story about three separate assets. It's a story of capital flowing through a failing system, a sequence driven by the unique properties of each asset. Phase 1 is hide. As fear takes hold, capital seeks preservation in the oldest safe haven, gold. We saw this in 2025. But this success is its downfall. The rush into paper gold strains the delivery system until it breaks. Gold becomes frozen, valuable but inaccessible. Phase 2 is panic. The moment people realize their gold is trapped, they panic into anything tangible. Capital floods into silver. But the silver market is a trap. Its physical supply is already consumed by industry, and the wave of monetary demand makes it evaporate instantly. Delivery fails. This is the final alarm bell. Phase 3 is settle. With trust in both physical delivery and paper promises broken, only one thing matters: settlement. This is where Bitcoin's unique properties become everything. Capital flows to it not as a speculation, but because it is the only functional rail left for transferring value. Permission not required. This three-stage sequence, hide, panic, settle, is a framework for understanding how a systemic crisis unfolds. Gold is your hedge against the coming storm. Silver is the barometer that tells you when it makes landfall. Bitcoin is the escape vehicle for navigating the flood. Where should you put your money in 2026? The answer is not to pick one winner. It is to understand the role each asset plays and to prioritize access over a paper price. Gold is your foundation. The key lesson is to prioritize physical ownership. If you don't hold it, you don't own it. Holding physical gold outside the banking system is your insurance for the hide phase. Silver is your early warning system. Owning physical silver gives you a tangible asset that is also a critical commodity. Its disappearance from the market will be the clearest signal that the crisis is escalating from a financial event to a real-world breakdown. Finally, Bitcoin is your plan for the endgame. It is your lifeboat for the settle phase. Having a position in Bitcoin, held in self-custody where you control the keys, is your hedge against a total failure of the trust-based financial system. It ensures that no matter what happens, you have the ability to move and control a portion of your wealth. The coming years will not be about picking the asset that goes up the most. It will be about owning the right asset at the right time for the right reason. It is about having a plan. Preserve your wealth with physical gold. Watch for the signs in the silver market. And secure your freedom to transact with self-custodied Bitcoin. That is how you navigate what is coming. Which asset are you betting on for 2026? Gold, silver, or Bitcoin? Let me know in the comments below. If you're preparing for all three phases, comment sequence. That tells me you're focused on mechanics, not headlines. You're watching the plumbing, not the price. And if you found this analysis valuable, hit that subscribe button and turn on notifications so you don't miss our next video. Stay prepared.